We are now going to begin our sixth session, which is dedicated to understanding China and Africa through data. This was really a terrific experience for me to be able to read these papers. I actually hail also from the development field, but from a Latin America perspective, and it was really interesting for me to draw some parallels between the two regions. So what I'll do first is introduce the speakers, and then I'll draw out some of the themes of the main papers. So to begin with, we have Xinshu Tang, who's a political science graduate at Brown University. He focuses on geographic and historic factors that shape political economic developments. We also have Dr. Matthew Di Lorenzo, who's a research analyst for aid data, and he explains the allocation of aid within developing countries. We also have Scott Wingo from the University of Pennsylvania, who focuses on China's engagement strategy in the developing world. And finally, Dr. David Landry, who's a PhD in international development from SAIS, working on issues of economic development and good governance with a regional focus in Africa. You have their more extended bios in the packet that you have at your seats, so feel free to take a more extended look there. So I want to just introduce, before we go to the individual presentations, some of the themes here. Of course, the conference has been going on now for about a day and a half, so I'm sure you touched on some of these themes, but for me, sort of the key issue or the key way to kind of frame these papers together to some extent is myth-busting, right? Deborah Rodegam had a terrific piece commentary in the Washington Post several weeks ago, basically looking at some of the diplomatic overtures that were coming from Washington, D.C. and the Secretary of State, and digesting, okay, well, on the ground, right, how much empirical reality is there? And so what we're seeing with these papers is basically asking questions, right, myth-busting, right? There's a lot of these ideas about what's China's motivations in Africa, what China's motivations are in the developing world, and sometimes we get sort of hardline reactions to this, right? So for example, former Secretary of State Tillerson, before he had traveled the region, would talk of predatory loan practices, opaque sort of contracts, China bringing its own workers, grabbing Africa for land and resources. Deborah in her article highlighted how even things like that, right? Most of the labor that tends to come is engineering, kind of higher, technical expertise, and a lot of the manual labor tends to be from Africa, right? 3/4 of it tends to be from Africa. Similarly, these papers each try to look at similar kind of themes and ask, okay, do these sort of supposed motivations map onto the reality on the ground? And so first we have Xinshu Tang, who basically says, is China's aid to Africa driven by the need for natural resources, right? Is this the primary motivation for why we see China investing abroad? We then have Dr. Di Lorenzo, who looks at the idea of regime stability, right? Regime stability is also something that often comes into play when we think of China's role internationally, and a lot of times, there's the perspective that maybe China prefers regime stability. Dr. Di Lorenzo instead looks at the electoral calendar and says, well, when does the political opening that comes from electoral turnover perhaps create an opportunity for China to buy influence locally, right? So he explores that issue. We then have Scott Wingo, who essentially looks at one of the big debates about, okay, how exploitive, right? There's this idea, is China's financing abroad exploitive? And he tries to break it down and classify it according to geostrategic interests and commercial interests, but basically puts forth the notion that, hey, perhaps it's as geopolitical and commercial as any other country, right? And then finally, we have Dr. Landry, who asks the question of institutions, right? A lot of times there's this notion that, okay, China will be less concerned about traditional governance and institutional concerns that we see from the Washington Census and post-Washington Census, such as things like corruption and human rights and quality of institutions. Does this pan out in reality, right? Is this empirically true? So without a further ado, we will now sort of move on to each speaker, and they'll sort of take on these myths one by one and share with you, by using these great new data sets from CARI and A-Data as well, share with you what they found in terms of the empirical reality on the ground. So to begin with, we turn to Xinshu Tang.
Okay, good morning. So thanks for having me here today. I'm very happy to share with you a project I'm working on, which is quite preliminary. And I have to confess that I am not an African expert, so please let me know if my knowledge of Africa is wrong. So actually, this research originated from a very simple and old question, that is China's aid to Africa driven by the need of natural resources. It is one of the myths Professor Brodgam identified in the article China and Africa Some Myths. In that article, Professor Brodgam finds that it is actually political factors rather than the need of resources that have driven Chinese aid in Africa. However, the debate didn't stop there. 2 months after the publication of this article, there is one article published by The Economist, which still claims that China is holding African resources. China is building roads and bridges because even far from the oil fields, because it pays. And scholar Sun from Brookings, she also finds that much of Chinese financing to Africa is associated with securing the continent's natural resources. And in the book by Landry and Economy, they also argue that energy needs is behind Chinese aid in Africa. So it seems that there's still need to continue to investigate whether natural resources is really the driving force behind Chinese aid in Africa. We see a lot of case studies and reports of field work on this question, but as far as I know, empirical work studying this question is relatively limited. To be honest, I didn't find too much work. And in specific, I found that there are much more work which studies the effects of Chinese aid in Africa rather than the determinants of Chinese aid in Africa. So we find that, scholars find that state violence increases with Chinese aid, and that the Chinese aid can even offset the democratic promotion efforts by some European countries. And they also find that there are a very strong correlation between high perception of corruption related with Chinese aid. And this kind of correlation between corruption and foreign aid is not found in the case of aid from World Banks or other democratic countries. So in terms of the determinants of the Chinese aid in Africa, we found there are several papers. And Zheng and Krog, they find that natural resources do matter. Energy resource acquisition is behind Chinese aid to Africa. And the Hill and his co-authors find that actually what matters is the domestic politics in this kind of African countries. They find that the birthplace of national leaders, they get the most aid. In particular, Chinese aid to the birth regions of national leaders triples when the leaders assume the office of national leaders. So it's very significant, even triples. And the newest paper published in ISQ, we find that the foreign policy considerations rather than economic concerns is behind this kind of Chinese aid. So as you can see in my title of the project, I want to study this problem from a spatial perspective. So what do I mean by a spatial analysis? So if you have ever visited the Science Center in Nanjing, you will recognize this is a map of the Nanjing city in China. On the right, on your left side, the blue dot means the location of hospitals in the Nanjing city. And on the right side, the green dots, they are pharmacy stores in Nanjing city. As you can see, the point pattern of hospitals and the point pattern of pharmacy stores are very similar, because it makes sense that in China, this kind of pharmacy stores, they are more likely to cluster around the hospitals because they are more close to the market, the patients. So if the Chinese aid in Africa is determined by resources, we should find a similar pattern, right? If we can find a pattern of natural resources and a pattern of Chinese aid. So if the aid is determined by aid is determined by the resources, we should see a correlation between these two patterns, just like this. So, I employ three approaches of spatial analysis. One is point pattern analysis, one is grid cell analysis, another is common cross-national analysis, but I take into consideration of the spatial dependence of the observations. Yes, so my data come from two resources. So the mineral resources, the location of mineral resources is from the US Geological Survey, which provides the location of the mining facilities of various kinds of minor commodities. And the Chinese aid data in Africa come from the project of aid data, which provides more 1,650 projects. And this kind of aid data is geo-referenced with the specific location and the volume of the aid, so it's very useful for my research. These two maps are the intensity of the aid and the mineral resources. On your left-hand side, it's the mineral resources, and on the right, it's the Chinese aid. We can see that you can have a sense that the distribution is different. The hotspot of aid and the mineral resources are at different parts of this continent. But we can study this correlation between these two patterns more specifically and empirically. So our task is to determine if the distribution of event A is similar to that of event B. So this is an example. So we are given two point patterns A and B, and we can find the nearest neighbor in B of point A. So it means that we are given 2 point estimates, 2 point patterns for each point in in A. We can find his nearest neighbor in point pattern B. So actually, we can compute a statistic that captures the average distance of these 2 point patterns. So we got a statistic right. Then we can randomly reassign label A and B to all points. So we have a given point pattern, then we'll get a statistic. Then after this, we just randomly reassign the point label to all the points. Then we get a new statistic, right? And we repeat this process many times. And for each simulation, we compute the statistic use the random labeled points. So if we expect that the correlation between point pattern of resources and aid are very special, they are similar to each other, we should expect that the statistic from the given point pattern of aid and resources is very different from the point pattern, the random assigned point patterns. Like as we see in the Nanjing hospital and pharmacy stores example, the correlation of point pattern of hospitals and pharmacy stores should be very different from the correlation between pharmacy stores and the schools, restaurants, and the shopping malls, right? But this is what we got. The histogram is the statistic of the simulations. It's 1,000 simulations. And the red line is the red vertical line is the original statistic we get from the given point pattern of aid and mineral resources. Actually, we see the red line is very close to the average of this statistic we get from the random samples. So we can what does it mean? It means that we cannot reject the non-hypothesis that the correlation between the point pattern of aid and the point pattern of resources is close to random. So in the Nanjing example, we should expect the red line at the far left side of the graph rather than at the middle. So this simple point pattern analysis says that maybe there's not a very close relationship between the distribution of Chinese aid and the mineral resources. And I continue to conduct a cross-national analysis, but I use the spatial model. The dependent variable in the first two columns are the aid count in each country, and the main explanatory variable is the count of these kind of mineral resource locations. In the OS model, there's no significant effect. And in the suggested spatial lag model, still no effect. And then I use a new dependent variable that's the aid volume capital of each country. There's still no significant effect, and the coefficient is even negative. So for us conducting the cross-national analysis, there is a fundamental problem. That is, the political boundaries are endogenous to territorial economic conditions and affect endowments. In another sense, that there is always unobservable factors that affect both the dependent variable and the independent variable. So how can we tackle this problem? So I use this grid cell analysis. So I create a fishnet of 2 by 2 degrees, and then I intersect the fishnet with the African continent. So what I got more than 1,000 grid cells. So now, rather than using the country as a unit of analysis, I use these grid cells as unit of analysis. So this is a map of the Chinese aid in Africa. So for the dark color means there's more aid, and the white color means that there's no aid in this grid cell. So this is the result of this grid cell analysis. So in the OS model, there is a small quality effect of the counts of mineral resources on the aid account, but the R-square is very small, which means that it can only explain a very small amount of variations of this kind of distribution of Chinese aid. And in the suggested spatial error model, the positive coefficient still remains, but the R-square is also very small. So I just want to conclude here that I think the contribution of this paper is that I provide some new and special answers to a very old question that whether Chinese aid is mainly driven by this kind of natural resources. So you can see actually I do not have a clear answer. The results are somewhat mixed. But there is a potential influence of the mineral resources at a very small scale, at the grid cell scale. And why we didn't see this kind of correlation in country level or in the whole continent level? But we only see this effect of mineral resources on aid at a very small grid cell level. My hunch is that maybe my hunch is that mineral resources is not a primary concern when choosing the recipient country. If China is making the decision which country to fund, which country to aid, mineral resources is not a primary concern. But once the country is chosen, then the specific location of the aid, I think is maybe driven by the military resources. But I need further work to demonstrate whether it's correct or wrong. And I think there are some further work I can do that I can use the same analysis at the subnational level analysis, and I can also work on the aid project level. And in the point analysis, I only talk about the location, but actually we can talk about both the location and the volume of aid at the same time. Actually, that is the market point analysis. So, thank you. That's it.
So when looking for the relationship between natural resources and aid, perhaps look in the micro rather than macro level. Next up, we have Dr. DiLorenzo, who will talk about the question of political turnover and Chinese development aid.
All right, well, thank you everyone for coming. Thanks for inviting me. I'm very happy today to present some joint research with one of my colleagues at AidData, who's here today, Mengfan Cheng, on political turnover and Chinese development cooperation. And as Professor Kaplan was saying, I think the characterization of this project is sort of responding to or engaging in this sort of myth-busting exercise was sort of our motivation for pursuing this project. So I quite like that framing. So the question we're investigating in this paper and sort of the sort of tradition we're operating in is trying to explain cross-nationally China's development investments. And in particular, we're interested in looking at whether leadership turnover in recipient countries or potential recipient countries influences patterns of China's development investments. And the way we came to this question was sort of, sparked by sort of recent examples in the Philippines, in Afghanistan, where new leaders came to power, and sort of those transitions coincided with these sort of generous development cooperation packages from China, and some of the accompanying commentary in the media relating to these packages sort of accused China of sort of stepping into something of a political vacuum, or sort of trying to take advantage of a political moment to gain influence in context where the United States is traditionally perhaps more influential. And so we wanted to think about whether this claim has sort of broader merit in the political science literature, and whether we can find any systematic evidence across many cases over time that China does respond in this way to leadership turnover. And so in consulting the political science literature on leadership change, and in particular coalition change, so instances where not just a country has a new leader, but has a new party in control of policy, for example, many argue that these types of changes create uncertainty about the future direction of policy. That new groups have not had chances to sort of credibly commit to policies yet. There's uncertainty about whether things that groups claim that they support or claim that they're going to do once they're in office, whether they'll actually pursue those things once in office, creates uncertainty. And sort of consistent with these, interpretations of these deals, we think that there's the potential that there's something of a potential window of opportunity for external actors to sort of try to get their foot in the door, to buy influence at a time when domestic actors are sort of jockeying internally for political influence. And so we, in consulting this literature and thinking about whether these claims have merit, we have some, initial reason to expect that maybe there are good theoretical reasons to expect that China and perhaps other donors would behave in this way. So in outlining our sort of baseline expectations, we developed the basic argument thinking about, sort of more concessional forms of finance, but of course we know that much of China's development portfolio consists of less concessional finance, and so lots of empirical studies distinguish between these things, and we think that there's good sort of reasons to think about them in different conceptual ways as well. So on one hand, we expect that argument about domestic coalition turnover, creating potential incentives to sort of buy influence in a new regime. That makes sense for these more sort of ODA-like flows, these grants that are more concessional in nature, are not necessarily geared towards generating financial returns for China. If China is behaving in this way to sort of, forge new relationships with new regimes, it's this type of finance that we'd expect to be positively related to domestic coalition turnover. But all this other stuff is sort of these less concessional projects where the focus is on generating some financial return for China or Chinese actors. A lot of what we think we know from literature on foreign direct investment is that investors don't like political uncertainty, and so it would seem strange for this type of investment to sort of respond favorably to political uncertainty in that way. And so these are sort of our baseline expectations that aid that is more, or finance, excuse me, that's more concessional in nature may respond positively to domestic coalition turnover, whereas investments geared towards generating financial returns should sort of be discouraged by this political uncertainty. So to test this argument, we have a pretty simple setup. We're using the aid data China Global Official Finance dataset, which is a database of Chinese aid development projects throughout the period of 2000 to 2014. We follow some existing studies on that look at the determinants of Chinese investments in creating 5 different dependent variables measuring different categories of finance. So we measure all finance together. We separate out what our team has coded as ODA-like finance from OOF-like finance, which is other official finance. And then we separate out grants from loans. And so that's what we're explaining. Our primary explanatory variable comes from the change in source of leader support data set, which is essentially a database of leader transitions, where the authors of the data set have added an additional component to indicate instances where there are not only leadership transitions, but transitions in sort of the underlying base of domestic support that supports a given leader. So in the context of the United States, a change in source of leader support or a SOLS change would be something like a transition from a Democratic to a Republican president, leaders who rely on different sort of societal groups for support, whereas a transition between two Republican presidents would not constitute a change in the source of leader support. So it's slightly different from just leadership turnover overall. So our basic setup is we estimate a set of panel regression models with country and year fixed effects throughout this period. We also include sort of a bunch of potentially confounding variables, so things that we thought of that would plausibly affect or be correlated with changes in coalitions within countries and possibly with financing from China. Happy to talk more about that if anyone's interested, but this is really just the basic setup. We're just looking at, given a change in coalition in a country, do we see any change in the expected value of finance from China on these different metrics? And so I'll give you a simplified version of the output. So the main variable of interest in our study is coalition change. I've included leader change here too, also because it sort of went against our expectations, and we don't really know what to make sense of or how to make sense of it. But our baseline findings are that when we consider all finance from China over this period and look at the effect of a coalition change in a recipient country, we find a positive and statistically significant relationship between turnover and finance from China. So on average, countries that experience turnover tend to get more finance from China the subsequent year. When we break finance down into these different categories, so again, we said that ODA-like flows, and grants are more concessional in nature, whereas OOF-like flows and loans are perhaps less concessional. It's really, we find the ODA-like flows are what are driving this positive relationship in the full sort of sample of projects, which is sort of loosely consistent. So I guess we expect that it would be ODA-like flows and grants that would be positively associated. We find a strong relationship for the ODA-like flows, a sort of marginally significant relationship for grants, but nothing really for these less concessional types of finance. But sort of in contrast to what we expected, in all cases for this coalition change variable, the relationship or the direction of the estimate is positive. And we were somewhat puzzled by the results. So we control for leadership changes that do not entail a change in the underlying base of support. What came out of the models is that these changes are negatively associated with OOF-like finance and loans, which is slightly different from our argument that it's in particular coalition change that creates uncertainty about the future direction of policy. And so we certainly welcome comments on this if anyone knows how to make sense of this. So that's sort of the baseline setup that we have in our paper. But we also go on to think about conditions under which these relationships might vary. And so we think about two general factors. One is how, sort of the nature of the potential recipient's pre-existing relationship with China, and another is domestic institutions in recipient countries. So in this figure here, what we do is we basically calculate the expected change in various types of finance from China, conditional on a change in a domestic coalition for different types of countries. So for the dots and associated intervals that are sort of orange, that's the estimate for a country that votes exactly the same way as China and the UN General Assembly. The blue dots and confidence intervals are for a country that's a bit further away from China. And here we actually find no distinction between, basically the relationship between domestic change and the amount of money that you're getting from China does not depend on how closely you're voting with China in the United Nations, which was kind of surprising to us. But I think so one reason I think that might explain this finding is that countries are sort of surprisingly clustered around China in terms of UN voting, that lots of countries vote very similarly, so there's not as much variation as you might expect. When we use a different measure of your sort of relationship or position vis-a-vis China, we look at whether you're an ally of the United States or not, we actually do find differences between the groups. So for an ally of the United States, this is the points and lines in blue here. When you experience a domestic change, you get significantly more ODA-like financing from China. You get significantly less OOF-like financing from China, which is, perhaps these domestic changes cause more uncertainty in countries that China is perhaps not as close with, which discourages investment. And again, for grants, we see sort of marginally significant relationship for the effective domestic coalition turnover, but not necessarily distinguishable from non-allies in this case. So some evidence that your alliance status with the United States matters for this relationship. And then finally, we look at whether there are conditional effects of domestic institutions in the potential recipient countries. So a lot of research on domestic coalition turnover that focuses on how turnover creates uncertainty argues that there should be differences between democratic and non-democratic countries. So in democracies, there's much more transparency about what the policy positions of domestic groups are. Parties sort of rotate in and out of power more frequently. They have a chance to build policy reputations, and leaders tend to rely on broader bases of societal support, so there's sort of more policy consistency across different domestic groups. The implication being that given a domestic change, there might be in democracies less uncertainty about the future direction of policy. And our results are sort of broadly consistent with that expectation and that finding that others have demonstrated in terms of UN voting and international conflict patterns. We find that it's really in non-democratic countries, when those countries experience a change in the source of leader support, that's where we see these jumps in ODA-like financing and grants from China. So, in conclusion, the study, the findings are mixed, and in some cases we found things that we did not expect to find at all that we can't explain, but I think there's some statistical evidence that demonstrates that these domestic changes do correlate with patterns of Chinese investments, at least on some dimensions, but that this relationship depends both on recipient countries' relationship with China and domestic institutions in those countries. And so moving forward, I think one thing we'd like to bring in is potentially case study evidence, see if we can find support for this argument in actual cases. And then really, we focus on China, but sort of expanding the focus to consider other donors as well to see if the argument applies. So that's all. Thank you.
So like any terrific myth-busting exercise, we have variation, right? And so we do see some relationship between political turnover and overseas ODA from China, particularly in cases where the recipient country might be a US ally or a non-democracy. So now to continue with the theme, we turn it over to Scott Wingo.
All right, welcome everybody. Thanks for coming, and a special thank you to SAIS for organizing and inviting us all. My talk today is really inspired by a similar question as to that many of you have covered, and that's the exact motives and nature of Chinese financing in Africa. And what I mean by that can be made clear by something else that's been brought up several times recently, and that's Rex Tillerson in one of his last acts as Secretary of State doing my project a massive favor and starting to talk about Chinese loan terms publicly. He said that he saw a lot of Chinese loan conditions as a way of taking control of African infrastructure and resources. Now, that's a pretty big statement, and I think it merits a lot of investigation. There's been some work on this in the past. I think a lot of the debate as to how good or bad this is comes down to the nature of China's unique financing mechanisms. Now, some qualitative work coming from some Chinese scholars and official sources and some from Deborah Browdingham here at SAIS holds that a lot of this is about risk management. Things that China does, like tying aid to the use of Chinese contractors or collateralizing loans with commodities. That's basically defensive. It's about making sure you're getting paid back. But historically, it has been difficult, if not impossible, to really test this in the data Because as many of us in this room know, data quality with respect to Chinese activities until the past few years was not great. But I think now we're getting to a point where we can test some of these claims. At the same time, there has been some quantitative work done on this. In particular, the effort done by Dreyer et al. In a paper called Apples and Dragon Fruits compares Chinese to Western activities, kind of categorizing Chinese activities along similar lines, saying there's concessional ODA, there's non-concessional OOF, here are the patterns we see. And what I'm doing is really inspired by that, but maybe a little more using China's own categorizations of its own activities. What I mean by that is going to become clear in these slides that are coming. The way I approach this is through the idea of conditionality and a long-standing series of models in political science and economics about conditionality. Now, a lot of you are thinking, hold up a second, China doesn't do that. And in the classical sense, you're right. Conditionality traditionally means telling recipient countries, keep your capital account open, balance your budgets, and so on. It's good for growth. What we're not going to say out loud is that it also makes it more likely that you don't get into fiscal trouble, so we get our money back. So on the part of the West, it's partially about governance and beliefs, but it's kind of about protecting creditors as well. And there's been some work in the past, recently including, say, Randall Stone on the IMF or Chris Kilby on the World Bank, showing that they start to fudge a little bit on conditionality where U.S. national interests are concerned. And a classic case here is, let's just say, Pakistan. Pakistan's really important. And they've had some fiscal issues, maybe they have trouble paying back their debt a little bit, and they can say, well, we might be able to pay you back. Then we have less money to fight the Taliban and help your forces in Afghanistan. And the bank says, oh, okay, we got it. You can have a little more extra time, some more money. And so historically, we have found that geostrategic importance is associated with a little less conditionality. Same for diplomatic motives. What I'm saying that's new, and the diplomatic part is not new, what I'm saying that's really a contribution is broadening the notion of conditionality to include commercial motives, which historically, at least for a long time, have not been a part of the Western financing picture. So what I mean by this, and obviously I'm going to start talking about China here, is two principal commercial motives. One of them has to do with exports. China, particularly post-economic slowdown, has just a wee bit of excess capacity in construction and infrastructure sectors at home. You, as the leader of any nation, want to worry about your unemployment rate, and it's probably time to start finding markets offshore for some of that stuff. And so Africa is an important part of that strategy. Number two is trade in the opposite direction. Raw materials coming in. The world's factory floor is surprisingly short on all commodities that aren't coal and rare earths, and Africa is a big part of that picture as well. So they want to keep the tap open, if at all possible. And I say that these two commercial motives influence their choice of financing mechanisms as much as geopolitics, and you can see this in the data. Now, what are these financing mechanisms I'm talking about? There are actually several, and I'm going to have a slide for each here. First one, I'm going to start with the easiest one, grants, giveaways, money or equipment in kind. Now, these are nominally unconditional, but as we all know, there's often a little bit of an unspoken quid pro quo. I'm drawing a lot on the work of David Baldwin historically, who said there's no such thing as a real grant. There's always some kind of terms attached. The snarky example he gives is if you give somebody a grant and then they invade you, you'd be upset. It's too good not to recycle. Also, somebody else on the class panel brought up Marcel Mauss and the culture of gift giving. I had not thought of that until an hour ago, but thank you. Anyway, grants, you would think, even if they don't have any direct commercial payoff, and they might have some other kind of motives. And so I hypothesize that one, they are going to be used where diplomatic and geopolitical motives are at stake. Now, you're not getting paid back financially, but you might be getting your money's worth elsewhere. Also, I'm looking at corruption risks. Now, one of the easiest ways to dodge repayment risks is not to ask the person to pay you back. So you would expect grants to be given to more corrupt societies just as a way of getting around the question of even being repaid. And finally, lower income countries. Not everybody has the ability to pay back $100 million to $1 billion at a time, and donors know this, and so they will act accordingly. Now, the natural counterpart to grants is loans. Loans obviously do have repayment attached, so there's one difference. And in China's case, a large majority of them are tied. According to MOFCOM regulations, at least 50% of contract value must go to a Chinese firm. Now, what that means, apart from serving China's obvious motive in moving some of that offshore capacity to Africa, is that it provides a degree of risk protection as well. These things come from policy banks, which have connections to taxpayer funds, and they can be used to protect firms against the risk of non-repayment. The money is routed through Chinese contractors and not to the host government. So one, the contractors are kind of covered and the bank picks up the tab if the country doesn't repay. And two, the money never touches the host government's hands. And so in a low governance environment, this is a pretty effective risk management mechanism to avoid cash hitting bank accounts that they don't want it to hit. So I hypothesize that this is going to be used in countries with weaker governance, but that given China's other set of commercial interests here, they'll start to fudge on this risk management mechanism and tolerate a little more risk where a country has natural resources, and there's a little bit of reward to manage the well-established risk. Now on to the more extreme version of this, resource-backed loans. Oh, and I think I skipped over tied loans because they have a few more strings attached. They're a little bit more conditional, are not going to go to geopolitically strategic or geopolitically important areas. Now that brings us to resource-backed loans, which are the most conditional. They're like tied loans, but with the extra caveat that they are either repaid in commodities or commodities are used as collateral. So say in Angola, a lot of loans are repaid in barrels of oil. And in other contexts, they've done things like, if you don't pay us back, we're going to take your diamond mine. So if they're really, really worried about getting paid back, this is just an extra insurance policy. So I expect it to follow the same pattern as tied cash loans, but more extreme. More driven to corrupt countries, but an even higher risk tolerance for natural resources, given that these are explicitly resource motivated. Okay, so there are our more conditional forms. Let's move on to the less conditional forms of financing. One of them, construction contracting. Now, in the traditional Western aid world, this is not aid at all. It's an exchange of cash for building something new and fancy. But China doesn't really draw the aid business distinction so much. Their official documents make that very clear. And so they actually use this, at times anyway, as a tool of state policy. Now, it's a little bit hard to disentangle where it's an instrument of foreign policy and where it's just commercial. But one thing I can tell you is that they're a little less protected than the people receiving tied loans as part of a Chinese policy bank package. What that means is you would expect, at least hypothetically, that they would be a little more risk averse. They would go to less corrupt countries because they don't have this bulletproof vest of a loan package from the China Exim Bank. However, they might also be a little more risk tolerant in the presence of natural resources. A couple of people who have done interview-based projects that show that Beijing can kind of nudge some of these contractors toward countries that serve their interests. I would also expect that it's more effective at currying geopolitical favor because it's basically an even-handed business relationship and there aren't really any strings attached to speak of. Finally, the last of my DVs is foreign direct investment. Again, not really aid, but not irrelevant either. Now, this one's hardest to measure, I should say, because the data quality tends to jump quite a bit between different sources. But keeping that in mind, we can hypothesize it similarly to construction contracting. Similar to contractors, there's a longstanding debate as to how government-run your average state-owned enterprise really is. Oystein Tunzio wrote a book on China's state-owned oil firms, and he had some quip at the beginning on how he would ask government officials whether the companies were state-run. They said, oh yeah. He would ask company bosses whether the companies were state-run. They said no. He said truth somewhere in between. So what I'm saying here is that in general, investors are going to do what equity investors usually do and avoid the dodgy markets, go to the more lucrative ones. But sometimes in the presence of natural resources or some kind of state interest, they can get kind of nudged to make a riskier bet. Now, also, this is more useful geopolitically because this is an odd way of thinking of it, but it has fewer strings attached than, say, a tied contract or a resource-backed loan. And so, in a relatively unconventional sense, it's a little bit less conditional than some of these other packages. Okay, so that's my prediction so far. Data and methods, I know I'm a little bit time constrained here, so I'm not going to go into this in depth, but I use a wide variety of data, including loan numbers here from CARI and from AData, as well as FDI numbers from Derek Scissors' Heritage AEI project and official sources. The trickiest part is resource-backed loans. I self-code this based on a number of sources up on the slides here. And then do a little bit of investigating online myself, searching for additional ones. My workhorse in terms of model specification is Tobit. This is because the data is heavily zero-inflated. For many country years, nothing happens. And a Tobit is a censored model that is able to deal with that proliferation of zeros. I also have some other model specifications that are less featured in these slides, so I'm going to skim over them. Now, if you're already a little bit tired of hearing stats and numbers talk, I've got some good news. I'm going to switch over to pretty pictures. Here is a visual depiction of my results for comparing grants and loans. And I apologize, the text may be a little smaller than I anticipated, but the x-axis is aggregate commodity exports to China on a log scale in the previous year. The y-axis is the effect of control of corruption, emphasis on control. High numbers are less corrupt, low numbers are more corrupt. Now what you can see is for red, in this shaded area is the 95% confidence interval, your margin of error. The red is loans. And for loans, they generally like less corrupt places in the absence of commodity exports to China. Now on the left-hand side of your screen, lenders are risk averse. They want to get their money back. But as you go to the right-hand side of the screen, where the commodity interests are much more pronounced, they are actually drawn to more corrupt environments. So what I'm reading into this is that they're lenders like anyone else, but they're willing to take a lot more risk where there is more reward concerned, and that they have these risk management mechanisms in the form of tied aid that allows them to do this. Grants, on the other hand, you see pretty much no correlation with corruption, contra to my previous expectations, and also no real influence of commodities. They're pretty politically neutral in this sense. Next item, we're going to disentangle loans into those collateralized with resources and those that are not. And as you can see, it's not the same. Green here is backed with cash, and you see some of the same tendencies, but not dramatic, whereas resource-backed loans, that interactive effect is much more pronounced. They really, really focus on more corrupt resource-producing countries because they have this risk management mechanisms. Now, in looking at aggregate countries, you can see this in the data. Over here, countries in large print did receive resource-backed loans at one point, and countries in red are above mean for commodity exports to China. Now, there's a big overlap in these groups, but some of these countries off to the right, a little more cleanly governed, like Zambia, South Africa, Algeria, don't receive resource-backed loans. Being told that I'm out of time, but similar pattern for contract revenues, which are a little more neutral. All right, on that note, thank you guys. If you have any questions about my remaining findings, there's a lot. I'm happy to answer your questions afterwards. Thanks, y'all.
Thank you very much, Scott. Some very interesting findings. Basically, putting forth the notion that similar to the way many countries have behaved historically, we see a lot of similar patterns in the data, including tied aid, geopolitics, commerce, but it's not necessarily exploited, right?
Right, yeah, it's like everyone else.
Or it's just like everybody else.
No more.
So next up we have David Landry.
All right. Hi, everyone. My name is David Landry. I recently defended my PhD dissertation here at SAIS, actually last week. So my research consisted of 4 papers, and this is one of the papers. It's more preliminary than some of my other papers, but it's more relevant also to this conference. So, all right. So my research, as that of the other researchers, looks at Chinese finance in Africa and engages in some myth busting as well. So those are two quotes here, two existing notions that have been repeated and that have informed a lot of policymakers' views in the West. So it's been hypothesized that China engages more in more corrupt countries and that the impact of Chinese engagement is worsened governance outcomes. So that's what my research intended to test. And then there's been quite a lot of research, especially in the 90s, looking at the determinants of development finance, ODA especially from Western countries, and how institutional quality played into that. So my research for this paper kind of combines that and looks at the determinants of development finance from the West and from China. And the way I structured my models, I can explicitly compare the two. So if you're hoping for something that's not quantitative and not number heavy, then that might not be the right presentation for you. And since it's the last presentation, then yeah. All right. So my rationale, as I mentioned, is to test the notion that China is less concerned with institutional quality than the West. And I also want to look at how different institutions impact development finance. So there's been quite a lot of research on corruption and democratic quality and how that impacts Western development finance, but there hasn't been as much on, for example, the impact of human rights. And then to engage more with the existing literature, I also test political alignment, bilateral trade, poverty, and natural resources wealth. So my variables of interest, the outcome variable is Chinese development finance, and it's CARI data. So it's Chinese government loans to African governments or business. So the Chinese loans, obviously, as we all know, the line is more blurred with Chinese economic engagement than that of the West. So, so in order to make it as close as possible to an apples-to-apples comparison to OECD data, I look at the loans from China's policy bank, so especially Exim Bank and China Development Bank, and the Chinese Ministry of Commerce. And my independent variables are a PCA weighted average of my 4 institutional indicators, so corruption controls, political stability, democratic development, and human rights. The corruption controls and political stability are from the Worldwide Governance Indicators. Democratic development is an aggregation of Polity 4 and Freedom House, and respect for human rights is the data by Singranelli and Richards. And then I look at GDP per capita, sort of the standard controls, and bilateral factors, so distance, UN voting patterns, and so the way the models are built, it controls for those factors, but then I have all the data combined, and I have a dummy variable that captures whether the loans are coming from China, France, Germany, the UK, and the US. And to determine whether China is different, what I do is I interact that China term or that China dummy variable with the variables of interest, and the outcome that it gives me is whether China is actually different. So there's been some research looking at the determinants of Chinese investment and Chinese loans. Dreher et al. And Dreher and Fuchs have published on that recently. But it's difficult to actually parse out whether China is actually different unless you build the models this way. So it's less about the impact on China directly, but more about whether China actually differs from the West. Oops. All right. So, as I mentioned, my data for China is from the CARI database, and we've narrowed it down to make it as comparable as possible to the OECD data. And my OECD data is the combined ODA and OOF, 2 African countries, and I used 2000 to 2015 for both. So here's the data. The data from the OECD countries is likely an underestimate because it doesn't include military aid, and a lot of the OOF figures that are presented in the OECD data is not fully comprehensive. So some export credit doesn't make it in. And also loan forgiveness gets subtracted from the total, whereas for the Chinese data, that's not the case in the way it was constructed. All right. So the actual models that I use, as Scott mentioned, there's a big zero inflation in development finance. So not all countries will get loans every year. So the way I deal with that is with a pseudo-Poisson maximum likelihood estimator. So basically, it's a model that is not biased by the presence of a lot of zeros, and you don't have to log your dependent variable, essentially, when you're running that model. And it's also consistent when there's heteroscedasticity in the data. Anyway, enough boring talk. I'll get to my results. I also run some OLS models, but I'm going to present the results from the PPML. All right. So one thing to keep in mind here, as I mentioned, the goal of my research is to determine whether China is different. So for the West, this is the results for France, Germany, the UK, and the US. And for China, it's actually the difference between China and the West. So to get the real effect for China, you'd have to subtract the coefficient for China from that of the West. So institutions have a slightly positive impact, but it's not statistically significant on development finance from Western countries. And for China, it has virtually no impact. What the statistical significance here tells us is that China is different, but in that institutions don't have an impact. And then what I find that is the most important factor for predicting China's development finance is political alignment. So so it makes the biggest difference in terms of UN voting patterns. It also sends more loans to trade partners, and interestingly, it also sends more loans to countries that are richer. And that's something, when you send loans to countries, you want your money back. So there are lots of common themes with my paper and some of the other researchers. But that is what I expect it to be. And it's interesting because it's development finance, so you would expect it to go to poorer countries, but there's a big incentive to get repayment. And as Tang presented, resources don't have a very large impact. It's statistically significant, but economically it's virtually non-significant in terms of this is resource rents as a percent of GDP, and it has little impact on China's development finance. So what I'm interested in then is looking at the impact of different institutions. So, for example, do countries that are more democratic get more development finance, or is it more about corruption, or is it more about political stability? So what I find is that in the case of corruption, Western countries do send more development finance to countries that have better corruption controls in place, but again, it's not statistically significant. And with regards to China, it's worse than the West, so it does send more development finance to more corrupt countries compared to the West, But again, it's the coefficient with China specifically should be subtracted from that of the West, and it's quite trivial. So a 1 standard deviation increase in corruption is associated with less than a 10% increase in Chinese development finance, which is in itself, that's not statistically significant. In terms of political stability, both China and the West extend more development finance loans to countries that are more politically stable, again, to get their money back eventually. The two institutional indicators where China actually scores negatively in real terms, in terms of sending more money to countries that score worse on those institutional indicators, are democracy and human rights. And so for most of the other institutional indicators, China's, institutions simply don't have an impact on China's development finance. And for democracy and human rights, which, obviously they correlate heavily, so those are all those results, by the way, are from separate models. But for democracy and human rights, those two have a negative impact on China's development finance, and virtually no impact on Western development finance. So the big finding is that yes, there is a difference between how China sends development finance and how the West does it, but the West is not as enlightened, or Western countries don't give more development finance to countries that have better institutions. There's some effect, but it's not statistically significant. And where the real difference is between the West and China. And but China is only really negatively impacted by institutional quality when it comes to democracy and human rights. Oops. So what this contributes to the literature is that first, the way that this data was compiled allowed for a more apples-to-apples comparison of China and the West, and the way the models were built, it gives a coefficient that explicitly highlights whether China is different from the West. So a lot of the research has shown how China sends FDI or trade or development finance to other countries, but in a vacuum, it's not, in my opinion, it's not as useful as if you can compare it to other countries that like to say to impose normative values on how China should do things. So this way, there's an explicit comparison that's happening. And it gives a distinction between institutional indicators. So thank you very much for attending. And as I mentioned, this paper is, I'm still editing it, and I welcome comments.
So here's how we'll proceed at this point. I'm going to use my speaker prerogative to quickly kind of pull out some similarities and differences between the papers and ask a first question. Then we'll open up the audience, taking 3 questions at a time. So to begin with, and to kind of look at maybe some of the core results, on net, there does seem to be some variation here, particularly if we pick up, right, with Dr. Landry, we can call you that now, right?
Officially.
Yeah, officially. With Dr. Landry's last point, right, which essentially highlights it's important to do a relative comparison, right, between the West and China from a statistical standpoint. And if we think of all the papers in that context, we have some variation here, right? Obviously, it's very difficult to disentangle political and commercial effects. It's something that everyone's trying to do to some extent, but it's a difficult thing. But when we do this comparison, West, right, versus China, there are some patterns that have come out, right? Some of the papers have basically put forth the notion that, hey, it's not altogether that different from Western financing. You still have geopolitics, you still have commercially driven financing, not all that different. We've also heard when we're talking about natural resources that oftentimes, right, it's dictated more of what's going on the firm level than necessarily the country level, right, or bilateral level. On the other hand, right, compared to Western financing, we do have some interesting patterns that have come out in some of the data work. For example, suggesting that when there is political turnover, we do see some patterns in terms of certain types of Chinese financing, specifically ODA, that it may move into countries in order to take advantage of an opportunity that comes from the political calendar. And this effect tends to be the strongest with U.S. allies as well as non-democracies. So political alignment still seems to matter, which also overlaps with some of the other papers. Finally, we also get this notion that compared to Western aid, relatively there's some difference in terms of institutions, but particularly in terms of democracy and human rights, right? That countries that score lower in these indicators may receive more aid from China. What I'd like the authors to take a moment and do is kind of think beyond their research projects and follow my cue and basically highlight on net the extent to which they think in their own research they have found data that either treats the West as a creditor just like China, and there's basically on net no difference, or to the extent to which they think within their research there are some signs that there are differences between the two types of creditors, right? Because I think bottom line, on some level, that's what everybody's trying to explain. So if you need to take a moment and perhaps quickly highlight that, and then we'll open it up to the audience. Perhaps we'll go from closest to me to further away, right?
Yes, although I didn't take into account the aid from Western countries, but I think it's a very potential project. So maybe I didn't find there was a special correlation between Chinese aid and the mineral resources in Africa. Maybe we can find whether there's also no special correlation between this kind of point pattern of Western aid and the mineral resources. I think it's very fruitful, maybe.
Yeah, so similarly, so we sort of completely punt on the question of comparing China to other donors in our paper, so we were sort of motivated in our paper by these sort of anecdotes involving China, and went about trying to evaluate those arguments systematically, and then in that process it occurred to us that the argument is more general, and so it's certainly something we would like to conduct a similar analysis for with other donors. We just haven't done it yet.
Yeah, I mean, to the extent that I really look at other donors, I didn't include it in this presentation. That being said, one area of real difference, and this is just my parochial research interest, is that China goes about its engagement in different legal and economic ways. Like, say, resource collateralization or tying of aid, those things were phased out by the West, and I think they reflect a fundamentally different view of what economic cooperation means. To the West, there's a distinction between aid and business. You're giving or you're doing a deal. To China, it's kind of all the same, and they don't really buy the idea that such a thing as pure aid has ever really existed. And so the strategic motivations, commercial interests or geopolitics, et cetera, are pretty much the same. But the normative ideas as to how to go about doing those and what's actually best for the recipient countries are actually different.
Yeah, I completely agree with Scott on this. So in an early iteration of my paper, I had Chinese development finance split between ODA and OOF-like flows. And for the purpose of this analysis, it made it difficult to compare to the West because China's development finance is predominantly OOF. It's predominantly export credit and tied, and some of it collateralized. And those are things that, yes, have been phased out by Western countries. Whereas for the West, I couldn't even I couldn't have used the same 4 countries to compare to China in terms of OOF because there was so little of it. And I'm sure there's more of it that just doesn't get reported. But when I was comparing OOF from all the OECD's OECD countries together, even that was minimal in comparison to China's OOF-like flows. So.
Thank you very much. We're now going to open it up to the audience. We'll do 3 at a time. I'm going to start left and move right. So 1, 2, and 3. There's a blue line going that way. So in the front, we'll start with our timekeeper.
Hi, Yunan Chen, PhD student here at SAIS. So I have questions for Jinshu Tang and Matthew DiLorenzo. Jinshu, really fascinating projects, both of you. I wanted to ask you about how much did you treat the geocoded data from aid data? I obviously, probably Matthew would know more about the actual data set than I do, but from what I've seen of it so far, there appears to be a few biases in how the geocoding might affect your conclusions. So a lot of these flows would be, if they're pure loans, they will probably be coded to the capital cities. So you may see skews in terms of bias towards capitals and urban areas. And for some of these projects, for long roads or railways, these are not characterized by their actual shape, but by a point. So I don't know how much you may have cleaned or stratified the geocoded data that you use for actual aid flows. And a minor quibble is on the grid cells that you show with the map of Africa. Did you use a Mercator projection in that? Because if you use the Mercator projection, then that might introduce a geographical bias in how you squish the cells in the middle parts of the continent compared to the poles. For Dr. DiLorenzo, the results that you showed with the positive and negative signs, do you have coefficients for just how big and substantial the change might be? So for a change in coalition for an African country that's a democracy, like just how much on average would we expect to see the amount of finance change from China?
Okay, so now we'll move to the second row, and then the third row, and then Fret Nat will move right shortly.
George Mason University. First, questions to Scott. I was wondering if, because you didn't find much significant correlation with grants, I wonder if it's because there's just not enough variation in grants, because China tends to spread grants more evenly. And also, I didn't quite understand how you distinguish the loans with the construction, because a lot of loans and export credits are really tied to construction. Right. And you also said that the construction is just less explicitly without state support, which also I didn't quite agree with. And questions to Dr. DiLorenzo. I wonder, because most of the deals, whether it's ODA or OF, take a long time to negotiate. So by the time the announcement is made, the commitment is made, it's already a long process that has really transpired. So how do you make the causal argument between the political changes and the commitment that's made at that time point? And finally, to Jinshu, I am a little bit unconvinced of your assumption that the infrastructure project or the 8 projects will be geographically correlated with resources, because if China's motivation is really to gain access to resources in a particular country, it doesn't really need to build that infrastructure project in that particular region. So I'm just not quite convinced of your assumption. Thank you.
Thank you very much. So, Folashade Soule, I'm a postdoctoral researcher at the University of Oxford. My question goes to Scott. Have you encountered some cases where, let's say, a loan, a concessional loan, has been turned into a grant during the negotiations? I'm giving an example. So I'm currently looking into a case study in Benin where a smart city is being built by a Chinese contractor, and in the beginning of the negotiation, it was supposed to be a concessional loan, but the negotiations turned more in favor of Benin because there were also international lawyers that were backed, and the decision from the Chinese side was to not give a loan, concede a loan, but give a grant instead for two reasons. Just maybe to add more conditionality, economic conditionality for Chinese corporations and some of the, steel, aluminium, etc. So do you have cases like that in your research? Thank you.
Okay, so we'll begin with responses with Xinshu Tang, and then we'll again move left or.
Okay, thanks for the question. So as I said, it's a very preliminary work. So of course, I think there are some problem with it when we use the aid data. You mentioned the capital and the infrastructure aid project like the aid road. I think one way we can tackle this is that we maybe exclude the capital city out of the example to see whether the correlation remains. That's one way I think I will do. And another question. Questions about the assumption. I think, so in the point pattern analysis, this is my assumption that maybe, but in the cross-national analysis, I use the contrast unit analysis. So I think I can, in the cross-national analysis, I think I can take into account. So if you invest in this country, I think your aim is to the resources within this country. So I do not think that's a problem for, maybe it's a problem for the point pattern analysis, but it's not a problem for the cross-national analysis. And I think, and one reason I think maybe I assume the closeness of between the aid and the resources is that the dependent variable in my the explanatory variable in my research is the mineral resources because I think mineral resources is different because if you want to invest or acquire these kind of mineral resources, your facility should be at a relatively close distance between the location of the mineral resources, right? It's not like all your other resources. So I think maybe the mineral resource is special, and we can accept the assumption that there should be some closeness between the aid and the mineral resource location. So, but we can talk later. Thank you.
So from coefficient size to time lags, we'll now move over to Dr. Lorenzo.
Yeah. And also, so sort of jump on that question too. I think the issue of dealing with the geocoded data is a very interesting one. So I don't use geocoded data in this paper, but I think like sort of accepted practice is become to exclude projects like you mentioned that go to the central government because we can't precisely tag them to geographic locations. And as far as I'm concerned, it's sort of like an open question of how to deal with that. And it's very interesting. So I just wanted to mention that. In terms of interpreting substantive size of the effects, no, we have not done any of that yet, but we should. That occurred to me as I was presenting. In terms of just sort of eyeballing the estimates there, clearly domestic changes matter far less than something like recognizing Taiwan for how much you're getting, but that's certainly something to add. And then the question on deals taking a long time to negotiate, I think this is a very good point as well. So we use basically the timing when the projects were committed as our dependent variable. And so I've heard concerns brought up before that, you don't know if the project is actually on the ground at that point for the purpose of looking at something like whether aid is effective on development outcomes. Because we're just looking at sort of the timing of commitments as sort of a gesture, I think that problem does not apply to our paper, but I think the point you raise is one that we should think more about, that if there's sort of, a lead up to the announcement of these agreements that we're not observing, we just observe when they are committed, then perhaps the correlations we're identifying are not as meaningful as we think we are. So we're lagging the variable by a year, so there's up to, I guess, a year for the deals to be negotiated, but I suspect you're probably right that there are instances where deals are negotiated over a much longer time period. So thank you.
Now we'll move to Scott Wingo with a lot of questions about the classification, right, and how you classify the various categories,
Yeah.
particularly grants and loans.
Right, right. So I'll start with the question as to whether the null findings for grants are because there's not that much variation. I mean, mathematically, almost certainly. The fact that they're not correlated with corruption or resources or anything else, not strongly, does mean that grants are used kind of across the board, at least in an African context, with almost all countries as part of a partnership building exercise. The reason I actually find them interesting anyway is for two reasons. One, they don't follow the same patterns as loans and FDI and so on. And as such, you can kind of view them as a placebo versus other forms of financing where there's an expectation of financial repayment or long-term equity stakes or what have you. Also, and this is a part that I didn't get to because I ran out of time, the last bit on geopolitical concerns, I do actually find that grants go more to geopolitically important countries, particularly those along the Indian Ocean coastline where China has navigational concerns. Same for the Mediterranean, which is kind of a secondary geopolitical interest. Whereas when you get to resource-rich countries, say on the Atlantic-facing part of Africa, grants aren't nearly as big a part of the picture. So there is some variation, just not necessarily in terms of corruption. Then your second question as to the distinction between loans and construction contracting, I have a couple of ways of getting around this. The model that I showed up here, I subtracted out loan disbursements per the CARI data from construction contract revenues. The reason I do this is the CARI data is reported on a disbursement basis. It's closer to cash basis, as are the official figures. So if you subtract one for the other, taking into account that they're different data sources and there's a little bit of fuzziness in year of financing and so on, you can get a more or less accurate picture of contract revenues that aren't backed by loans. I also use a couple of other models. Then on to the next question as to whether concessional loans are ever turned into grants. Yes. Now, formally, I'm not aware of this happening, but what does happen is often they have kind of a laxer approach to repayment, and so if somebody's behind, they'll just say, oh, you can have a few more years, so it de facto turns into kind of a grant. Yeah. Okay, I suppose we should move on to the other questions.
Let's shift over to this side of the room now, right here in front.
Yeah.
We'll begin here, and then number 2 over there, blue and white shirt, and then in the white, number 3.
Thank you for all the panelists. This is Yo Yi from Cornell University. First, I have several quick questions for Jixun Tang. I think you have done amazing spatial analysis. Your fundamental assumption is that there should be a special correlation between the location of the 8 projects and the location of the and the resource location. I want to challenge that a little bit because, for example, if China is interested in copper in DR Congo, actually they could invest, and the copper is located in the eastern part of this country, but they could invest. They could offer some aid project in the western part of this country, and then they can still express their interest in the copper. So you may detect some correlation at the state level, but not necessarily at the subnational level. So I think this is the question about your fundamental assumption. And then you have done the grid cell analysis. I just wonder how you operationalize your control variables when you do this grid cell analysis. For example, how do you measure the GDP per cell, and how do you measure the population per cell? I think this variable you should control, and I just wonder how you control this variable. One last comment is that so it seems that in your analysis you include all types of mineral resources. Actually, some China don't need. So probably you need to focus on those China really is hungry for. I think that may be more useful. And one last quick comment for question for David. So in your dependent variable is the Chinese loans from the policy banks. I wonder whether if you try to disagree there, because for that part there's concessional loans and the preferential export credits at 2%. There's also non-concessional loans offered by China Exim Bank and CDB Bank. I think there's still some slight difference between these two subcategories under the policy bank loans. I wonder whether you do this disaggregate analysis, whether you will find some different correlations or thanks.
And now we move to the blue and white, the hand up right there.
Hi, Michelson, New York City real estate agent, related. My question is for Scott. I wanted to understand a little bit more about like the scale of the various programs you mentioned. Like you had like grants, construction financing, resource-backed loans. Just wanted to understand like what the scale of each program is. And two is that it seems to me that China is doing this for strategic or capitalistic reasons. And then I wanted to know, in the course of your research, have you seen like kind of other countries or companies start stepping up their involvement with Africa, since China's now like kind of laying the environment to safeguard investors' money? And then also to the point where you mentioned that China has essentially kind of locked up the rare earth metals market. Like there's a statistic that said that they have like 95% of the market or of the resources, and that cobalt is a significant resource necessary for the electronic vehicle market, and both US and European players would want to partake in that. So just curious to see like if you start seeing other countries, companies are now starting to delve into countries that before the West kind of stayed away from because of corruption and whatnot, but now they kind of have to because of for defensive reasons.
Finally in the white.
Thank you. I really appreciate the panelists. They're saying that the two models are very different, the traditional donors and the Chinese model. Actually, in 2016, there was a policy paper recommending that the next president of America switch the aid-driven development model to the more Chinese model, the investment-driven development finance model. Based on my work experience in the Ministry of Commerce, China, and my understanding of our work in Africa, that's why we don't call it aid, we call it economic cooperation. Okay, that's something I want to say a little bit about. And my question for Dr. DiLorenzo, when I pull out the aid data, I found that the Chinese aid in Africa, when I break down the loan grant, I found that probably 60% of the loan is ODA-like, and 40% are weak, but still categorized as official finance. And OOF-like is neglectable. And I didn't find this pattern when I pull out the data as a whole for the Chinese development finance. So I wonder whether you can help me interpret it. Yeah, that's my question for you. And my question for Dr. To-be Wingo. So you talked about different kinds of loans and corruption. I wonder whether you studied the debt sustainability issue, and whether construction and contracting and the FDI loans are the most troublesome in terms of debt sustainability. Thank you.
So we've had some projects about spatial modeling. I don't want to be accused of clustering things too closely to my geographic proximity for this reason. We start with David, Dr. Landry on the other side.
So for your question, Yui, so earlier in my research, I had the data disaggregated, and what I found was that there was relatively little development finance that was on the more concessional side coming from the CARI database. And because my primary goal was comparison with the West, that's why I ended up lumping together ODA and OOF like development finance. But there is some, yeah, it's ideally, if either the OECD did a better job of producing data on OOF, or if China had, if there was more data coming from China, I could do an apples to apples comparison. But what I found for the type of model that I was using is that it was quite difficult to do that.
Move to Scott Wingo now.
All right, I guess I'll go in order. Start with Michael, your question about the scale of different types of financing. I do actually have a slide on that. It's the biggest chunk of it is in construction contracting, which is funny because it's the part of it you probably hear the least about, but I think it's a little less than half is contracting not directly backed by the state at all. It's a big deal for Africa, but not only indirectly supported by Beijing. Second biggest is credit in the form of loans, of which a third, give or take, are collateralized with resources in one way or another. Now that estimate varies. I talk about this in my paper. It's somewhere between 32 and 35% are resource-backed. Then FDI is a bit smaller, and grants are tiny, like 1 or 2%. As to the question of others reacting to China, it really depends who you're talking about. In the West, there's a lot of talk. It's hard to observe actual action, though. I haven't worked on this directly so much, but some others have. I would point you to a paper by Xiaojun Li from the University of British Columbia, who finds that the World Bank starts sloughing off conditions from their loans in countries that receive a lot of financing from China. And my personal view on this is competition is fairly limited in Africa because there's so much more demand than supply for financing that you could clone China a couple of times, watch India rise to developed country status, and they still wouldn't meet demand. Then there's the fact that Haley Swedlund pointed out in her presentation yesterday that the sectoral content is pretty different. The West tends to focus on the social sector like health and education. China's more in infrastructure. And there's maybe a little bit of head-to-head competition, but they're mostly two trains passing in the night. Then finally, your last question on cobalt. It's a big deal, and a large portion of the world's cobalt reserves are in the Democratic Republic of the Congo, which in Congolese history is not so much of a blessing as you might think. And there's a big game going on where Chinese mining interests are moving into what historically has been a European area of influence. And actors like even Tesla are watching this pretty closely and trying to make sure the lines are open. I truthfully don't follow it as closely as I should, but there's a lot going on there. Then as to the question on debt sustainability, I have not personally looked into this all that much. I was thinking about it for a future project, but I've probably bitten off more than I can chew already. I would say, however, that certainly FDI does not directly lead to debt unless it's somehow leveraged. And construction contracting, unless it's funded by a third-party financier, which is possible, would not incur any kind of debt. I would defer to others who are working on that more directly than I am, though. I don't want to say too much about it. All right.
Okay, next up, Dr. DiLorenzo.
Okay. So thank you for your question. So the question is basically about differences in the distribution of different types of projects in different regions, correct? Or basically, surprisingly, Okay. Yeah, I guess that is also kind of surprising to me. Like, so I've worked really with just the global data set, and so I don't know. But there's still, even though okay. Yeah, I don't know if it's a peculiarity of the coding. I don't want to put my co-author on the spot, but we can definitely. So she knows much more about the data and the quirks of it than I do. So happy to follow up after.
Okay. Thanks to Yoi for the questions. I think the first question is related to her question about the assumption of the location of the aid and resources. I think that's the reason why I use three spatial approaches, both the point pattern and the country level and the grid cell level. I think maybe it's a problem for the point pattern analysis, but for the cross-national analysis, even if you are interested in the minerals in the west, you may aid in a project on the east. But if you take the country as a unit analysis, it's not a problem, right? And as both of these two methods have the similar result, there's no very significant effect, significant correlation, so I think it's not a very big problem. And for the second problem, I do not have the time because at the grid cell level, the GDP growth, it was proxied by the luminosity, that is the satellite night light. I use this luminosity as a proxy for the GDP growth. And there are also raster data for the populations of the African continent. And there exists some other data that I think we can make use of them innovative. I think we can make use of some other data. I think there are some data about the soil quality and the plant type of the continent. I think maybe we can find a way to make better use of this kind of data. And I thank you for mentioning the types of minerals. I think that's a potential work I should do. Maybe not only think about the types of minerals, we can also take into account the price change of the commodity, see whether the price also will affect Chinese aid related to this specific kind of minerals. Thank you so much.
So we just have a minute or two left. So in closing, I thought what might be interesting is if we go down the line once again, and maybe a tweet version of what surprised you as a researcher compared to what you came in and thought, and then what you found out, right? So again, we'll start with Dr. Landry and move down this way.
So what impressed me the most? So I guess the way I framed my research was in trying to make my data as comparable as possible. I was forced to engage with kind of narrower questions and or frame it in such a way that I wasn't able to really explore in depth the effects on different types of Chinese development finance. One of my other papers looks at FDI and trade patterns, but I was very impressed by especially Scott's way of approaching the data and creative ways of forming new data sets.
Okay, so we move on to Scott. Surprised anywhere in the research process, even whether it's your own findings or what you learned along the way.
One really big surprise had to do with the comparison of official loans and construction contractors. I came in thinking that because construction contractors don't have this China XM piece of paper giving them a certain degree of risk guarantee, that they would be more cautious, but it's actually the other way around. I found them to be big on gambling, possibly because they have access to cheap credit at home, and the policy banks actually kind of reining them in, which I would not have seen coming. And I thought this was I questioned my own findings at first, but after talking to people here, this seems to be a fairly common conclusion.
Dr. DiLorenzo?
Yeah, I would say I was somewhat surprised that we found some support. It was, like you said, we sort of set out in this sort of myth-busting mentality, and then it turned out I think we identified some interesting things. I think we want to pursue them a little further, but I was surprised in that sense.
And
yeah. So before the research, I also think that the mineral resources is the driving force behind the Chinese aid, but as you say, the first two models just do not provide evidence. So when I'm going to accept the conclusion that there's no relationship at the we can see that at the grid cell level, there is a potential small potential relations. So I think that the world is more complicated than we think, and there's really a lot of work to do. Thank you.
Excellent. Thank you very much to everybody. Thank you to Deborah Bodigam for hosting, to SAIS as well. And a measure of a terrific conference is how much you learned, and I've learned a lot in the last hour and a half. So thank you to all our panelists, and back to Deborah.
Wow. It's been such a great 2 days, and this last panel was just as fantastic as all the other ones that we've had here. And standing before you, I also am acutely aware, as every other person who stood in the same position at the same time of the day, that I'm standing before you at lunch. So I'm now the third person to say that to you for the third meal. So I will be very, very brief. And I'm not going to give you major reflections on everything that I learned over the past 2 days, because I learned a tremendous amount, and I just thank everyone for this, because I have never been to a conference where I have learned so much about something I love so much, that is so near and dear to my brain and my heart. So I thank you all for that. It just, wow. So, another reflection, I think it's fascinating that as we see our final panel, it's all men. I'm just saying that we're doing affirmative action here in our field now by having a panel of men, you know, just to give them some representation, because
We did try to make up for it by weighting questions more heavily to the females.
Yes, but Steve, you can only say that because you haven't been at all our other panels, which have been almost, our first panel was all women, and most of the panels have been dominated by women. So, we had to give the men some representation. So I appreciate it, men, for coming to fill your token role here. And then the last thing, well, two more things to say. The next to last thing is to thank the marvelous Marie. And now, because Marie is French, we will call her La Merveilleuse for everything. And all of her merveilleuse help. And all of the names, I can't run through all of them because I haven't written them all down, but you guys, tremendous. What a team we have at CARI. And that brings me to the last thing I want to say, which is Zhejiang. Where's the famous Zhejiang? Okay. Zhejiang, she's little, but she's mighty. And Zhejiang will be heading off to do her PhD. I hope you're going to stick in our field, Zhejiang, because you are so good. But what Zhejiang does with us is she masters our data. So she is our lone master. And we are hoping that more people will use our data. We had some representation on the panels here. We were hoping that everybody would be using it. But just to tell you why it's useful, it's not just the data on our website. We are going to be later this year releasing, when we get the money to do it, much more in an interactive form. But we have things that will be useful to you. We, for example, Scott, we disaggregate the loans into zero interest loans, which are much more diplomacy related. And then the other loans would not be. So that'll be an interesting variation. That might work also for you.
Look forward to that.
Yeah, so it's already there. You only have to ask Zhejiang. I mean, she'll do it. I mean, she's available, and that's what we do. So, and that's what we expected you guys to come and ask us. So, but nobody did. We should have offered, I suppose. Well, David got it. So David got all of that. More comments for you later, David, because so many interesting things in your presentation, even after you just did your defense a couple of weeks ago. So that's just one thing. We have 20 different things that we have disaggregated the data into, the loan data. And so you can do a lot of slicing and dicing, which we've done on all sorts of things, including, Scott, we've already done all the commodity linked, yeah. So I mean, we have that as one of our variables. So
why did I bother?
Yeah, I'm sorry. Because we haven't been able yet to get, to do this thing. Anyway, I'm getting into the weeds because this is in the data, but it's what Jizhong's been doing for 4 years, leading most of the people who have been working with CARI, who are running around with their microphones, giving them to you. They've been doing this too. So we have a huge group. And what you see on the website is just like the smallest tip of the iceberg of what we have. Okay, so with that, technical note, we will continue these conversations, many of us later today, but we hope in later conferences and later meetings. Thank you so much for coming, and let's have lunch.